hidden within the Dodd-Frank Act, is a provision known as bail-in authority. This grants the legal power to seize your bank deposits during a financial crisis and transform them into shares of bank stock. It is not FDIC insurance. You do not get your money back. Instead, you receive stock in a failing institution. Cyprus implemented this in 2013, and account holders lost 47.5% of their funds overnight. The legal infrastructure for this is already established in the United States. With 186 regional banks excessively leveraged on commercial real estate holdings, the precipice is fast approaching. Let me reiterate this crucial point for absolute clarity. There is a law currently in effect that permits the government to confiscate the funds in your bank account and convert them into equity in a faltering bank. You have no say in this. Your consent is not sought. You might awaken one Monday to discover your $500,000 in the bank has dwindled to $262,500 worth of stock in a bank on the verge of collapse. And this is entirely lawful. You have been led to believe your bank deposits are secure throughout your life. This was a falsehood. The FDIC Insurance Fund currently holds $128 billion. The total volume of bank deposits in the United States amounts to $18.5 trillion. Perform the calculation. The FDIC can only cover 0.7% of total deposits, less than 1%. If more than 1% of deposits are jeopardized, the FDIC's funds are depleted. Presently, with 186 regional banks holding commercial real estate loans that are underwater by hundreds of billions of dollars, significantly more than 1% of deposits are at risk. Therefore, what transpires when the FDIC exhausts its resources? You will not receive a bailout. The bank will be bailed in using your funds. This is not a fringe conspiracy theory. It is codified in federal law and has already been enacted in a Western democracy. It proved effective, and now it is slated for implementation here. In this presentation, I will meticulously detail the mechanics of bail-ins, the existing legal authority in the United States to execute them, the 186 banks presently teetering on the brink of insolvency, and the projected timeline for these events. I will identify those who will suffer complete ruin and those who will manage to navigate through it. Furthermore, I will provide precise guidance on the actions you must take within the next 90 days to ensure you are not caught unprepared when the trap springs shut. Allow me to begin by elucidating what a bail-in truly entails, as this is a term most individuals are unfamiliar with, and that is by design. They prefer you remain ignorant. Historically, when a bank failed, one of two outcomes typically ensued. Either the government allowed the institution to collapse, resulting in depositors losing their money, or the government intervened with taxpayer funds to prop up the bank. The former scenario often triggers bank runs and widespread economic instability. The latter incites public anger, as taxpayers are compelled to subsidize the imprudent actions of bankers with public money. Following 2008, when the government allocated $700 billion of taxpayer funds to rescue Wall Street, immense public outcry ensued. Protests erupted in the streets and politicians faced threats. The government recognized the impossibility of orchestrating another bailout of that magnitude, as public tolerance would be non-existent. Consequently, they devised a novel strategy, a plan that would rescue banks without necessitating any expenditure of taxpayer dollars. This strategy is termed a bail-in. Here's how it operates. When a bank encounters financial distress, instead of the government injecting funds, it appropriates depositors' funds and converts them into ownership stakes. Ownership stakes equate to stock or shares. You become a shareholder in the bank. Your cash is transformed into stock. While this might initially seem acceptable, with the thought that you retain the same value, albeit in a different form, this is incorrect. Because the bank is failing, its stock is rendered valueless. If you possessed $400,000 in deposits, and this is converted into stock in a failing bank, that stock could be worth $200,000 the following day and $50,000 the week after. By the time the bank ultimately succumbs, or is acquired by an entity like JP Morgan for a fraction of its former worth, your stock might be valued at mere pennies on the dollar. You would have effectively lost 90% of your savings, and here lies the most critical aspect. You are unable to exit. The instant a bail-in is declared, trading in the bank's stock is suspended. You are rendered powerless to sell, effectively trapped. You are forced to witness your life savings disintegrate in real time, with no recourse. You may believe I am exaggerating, that such an event is impossible in the United States. Allow me to recount the situation in Cyprus. In 2013, the small island nation of Cyprus experienced a banking crisis. Its two largest financial institutions, Bank of Cyprus and Laiki Bank, were on the verge of collapse due to substantial bad loans extended to Greece. When Greece defaulted on its obligations, these Cypriot banks found themselves holding worthless Greek bonds, rendering them insolvent. Cyprus sought financial assistance from the European Union, which refused to provide taxpayer funds, insisting Cyprus must resolve the issue internally. Consequently, Cyprus implemented the first large-scale bail-in in modern history. Here is what transpired. On a Friday evening in March 2013, the government announced that all bank accounts exceeding 100,000 euros would be subject to a bail-in. If you held 200,000 euros in your account, a significant portion was slated for forfeiture. The banks were shuttered for 2 weeks. ATMs were deactivated, and access to funds or the ability to transfer them was impossible. Depositors with balances above 100,000 euros discovered that 47.5% of their funds had been converted into shares of Bank of Cyprus. Consequently, an individual with 200,000 euros would have 15,000 euros in cash and 95,000 euros in bank stock. However, this bank stock was virtually worthless, having depreciated 70% of its value within months. In effect, these depositors lost closer to 80% when accounting for the plummeting stock value. Small business owners whose operational capital was held in these banks were devastated. Retirees who had entrusted their life savings to these institutions lost everything, irrespective of their responsible financial conduct. The government decreed that their deposits would be sacrificed to salvage the banks. Crucially, this action was lawful. The European Union had enacted legislation post-2008 empowering governments to conduct bail-ins. Therefore, Cyprus's actions were legally unimpeachable. Depositors had no legal avenues for appeal or litigation. The law sanctioned the government's appropriation of their funds and conversion into stock. This is precisely what occurred. You might be thinking this is an isolated incident concerning Cyprus, a small island nation with a compromised banking system. You might believe this could never happen in the United States, citing the FDIC and existing protections. This assumption is incorrect. The identical legal framework employed in Cyprus is in effect within the United States, embedded within the Dodd-Frank Act. Specifically, Title II of Dodd-Frank grants the FDIC the authority known as Orderly Liquidation Authority. While this is the official designation, its practical application is bail-in authority. Allow me to quote the relevant section. Title II, Section 2, 110, empowers the FDIC to assume control of a failing financial institution and, as stated, convert debt or other obligations into equity. In layman's terms, this means they can seize your deposits, which are considered a debt owed to you by the bank, and transform them into equity, or stock. This legislation was enacted in 2010 and has been law for 15 years, yet it remains largely unknown to the public. It was presented to the public as a mechanism to prevent future bailouts. Technically, this is accurate. There will be no bailouts, but rather bail-ins. You will bear the burden of the bank's failures, not the taxpayers. However, the ultimate outcome remains the same. The banks are rescued and you lose your money. Now consider the even more concerning aspect. The FDIC has already conducted simulations of bail-in execution. In 2012, a joint publication by the FDIC and the Bank of England outlined a precise strategy for implementing bail-ins in both the US and the UK. The paper is titled, Resolving Globally Active Systemically Important Financial Institutions, and it is publicly accessible. The strategy is referred to as the single point of entry approach. Here's how it functions. When a major bank faces collapse, the FDIC seizes control of the parent holding company, liquidates the shareholders, and then converts bondholders and depositors into new shareholders. The bank continues to operate under new ownership, your ownership in essence, yet it remains insolvent, rendering your stake worthless. The paper explicitly states that this approach will impose losses on shareholders and unsecured creditors, and that deposits above the insured limit may be converted to equity. Unsecured creditors refers to you. Your deposit is an unsecured loan to the bank, and they are openly declaring their intention to convert your deposit into stock, obligating you to absorb losses. This is not concealed. It is not a clandestine conspiracy. It is official policy disseminated by the FDIC and the Bank of England. They are clearly articulating their intentions, albeit using technical jargon designed to obscure their meaning from the general populace. Now that you are aware of the legal framework and the meticulously crafted plan, the pertinent question is, when will this occur? The answer is, when the next banking crisis emerges, which is imminent. Currently, 186 regional banks in the United States exhibit exposure to commercial real estate exceeding 300% of their capital. To elaborate, capital represents a bank's reserve, the equity it possesses to absorb losses. If a bank has $10 billion in capital, it can withstand $10 billion in losses before becoming insolvent. Commercial real estate exposure refers to loans extended by the bank to entities such as office buildings, shopping centers, hotels, and residential complexes. Should these loans default, the bank incurs losses. Consequently, if a bank possesses $10 billion in capital and $30 billion in commercial real estate loans, its commercial real estate exposure stands at 300% of its capital. This implies that even a 1/3 default rate on these loans would completely deplete the bank's capital, rendering it insolvent. Presently, 186 banks find themselves in this precarious situation. They have originated such a substantial volume of commercial real estate loans relative to their capital that even a moderate number of defaults would lead to their demise. Furthermore, the commercial real estate sector is presently experiencing a crisis. Office buildings are operating at 30% vacancy rates due to the prevalence of remote work. Property values have plummeted by 50% since 2021. However, the loans secured by these properties were issued in 2021 based on prior valuations. A building valued at $200 million in 2021 is now worth $100 million. Yet the outstanding loan amounts to $150 million, leaving the property significantly underwater. The owner is unable to secure refinancing, leading to default. The bank forecloses, sells the property for $100 million, and incurs a $50 million loss. When this scenario is extrapolated across thousands of properties and hundreds of banks, the aggregate losses are projected to be immense, potentially ranging from $400 billion to $600 billion in total commercial real estate losses across the banking system. The 186 regional banks most vulnerable to this situation lack the capital reserves to absorb such losses, which would lead to their insolvency. When these banks fail, the FDIC will intervene. However, the FDIC lacks the financial capacity for a bailout. The FDIC's insurance fund contains $128 billion. If merely 10 of these banks were to fail, each with an average of $20 billion in assets, that equates to $200 billion in assets. Should depositors at these institutions panic and attempt to withdraw their funds, the FDIC would be obligated to cover insured deposits, capped at $250,000 per account. If each bank holds $10 billion in insured deposits, that amounts to $100 billion in total claims. The FDIC fund would be depleted by the failure of just 10 banks. And we are not discussing 10 bank failures. We are contemplating 186 banks at risk. If even half of them were to fail, that would be 93 banks. The FDIC would be entirely incapable of covering such a widespread collapse. Therefore, what course of action would they pursue? They would implement bail-ins, seizing uninsured deposits exceeding $250,000 and converting them into stock. The bank would continue to operate, insured depositors would receive their funds, but uninsured depositors would receive stock in a failing institution, all without the taxpayers footing a single dime. The problem is ostensibly resolved, except for the uninsured depositors who face complete ruin. Now, who possesses uninsured deposits? Who has more than $250,000 in a single bank account? You might assume this only affects affluent individuals. You might think, I don't have $250,000 in the bank, so I'm safe. This is a misconception. This situation impacts the middle class more profoundly than you might realize. Consider the following individuals who hold uninsured deposits: small business owners. If you operate a business with $2 million in annual revenue, you must maintain sufficient operating cash in your bank account to cover payroll, rent, supplier payments, and retirement contributions. If you are 68 years old, have recently sold your home for $600,000, and are holding this money in the bank while you identify investment opportunities, you are above the insured limit. Should your bank fail next month, your $600,000 would be converted into $315,000 worth of stock in a collapsing bank, decimating your retirement plans. Trust accounts. If your parents established a trust for you with $400,000, and the trustee is keeping these funds in a bank account, you exceed the insured limit. A bail-in would effectively wipe out half of these funds. Escrow accounts. If you have recently sold a commercial property and the $800,000 is held in an escrow account at a bank pending closing, and the bank fails before the transaction is finalized, the escrow account will be subject to a bail-in, and you will lose the funds. This is not an issue confined to billionaires. It directly affects the middle class and small businesses. Millions of accounts nationwide hold balances exceeding $250,000. The total volume of uninsured deposits in the U.S. banking system amounts to $8.9 trillion. This represents the capital at risk, the funds that will be subject to bail-in when the crisis erupts. You might be contemplating spreading your funds across multiple banks. For instance, keeping $250,000 at Bank A, $250,000 at Bank B, and $250,000 at Bank C, thereby ensuring full insurance coverage everywhere. This strategy is effective if only a single bank fails. However, in the event of a systemic crisis involving the simultaneous failure of numerous banks, you face a different predicament. Your funds are dispersed across multiple failing institutions. Even if each individual account remains below the $250,000 threshold, the FDIC might still be unable to disburse funds in a timely manner due to the overwhelming strain on the system. During the 2008 crisis, when Washington Mutual collapsed, it took months for depositors to regain access to their insured funds, and that was a single institution. If 93 banks fail over a 6-month period, the FDIC will be utterly overwhelmed. You could potentially wait a year to recover your insured deposits. For a small business, a year-long delay translates directly to bankruptcy. Therefore, diversifying your funds across multiple banks does not truly resolve the problem. It merely presents a different manifestation of the same issue. Allow me to now guide you through the precise sequence of events that will unfold during a bail-in in the United States, drawing parallels with the Cyprus model and the FDIC's own planning documents. Step 1. A regional bank with substantial commercial real estate exposure reports significant losses. For example, consider a bank with $50 billion in assets. It announces that defaults on its commercial real estate loans have resulted in an $8 billion loss. With a total capital of $4 billion, the bank is insolvent by $4 billion. Its stock price plummets, triggering widespread depositor panic. Step 2. Depositors attempt to withdraw their funds, initiating a bank run. Within 48 hours, $10 billion in deposits are withdrawn. The bank does not possess $10 billion in physical cash on hand. These funds have been loaned out. The bank confronts a liquidity crisis and is unable to fulfill withdrawal requests. Step 3. The bank seeks emergency financing from the Federal Reserve. Upon reviewing the bank's financial statements, the Fed determines it is insolvent and refuses to extend credit to a failing institution, effectively signaling the bank's demise. Step 4. The FDIC steps in. On Friday evening, the FDIC announces it is assuming control of the bank. The institution is closed, all branches cease operations, online banking is suspended, and access to accounts or the ability to transfer funds is prohibited, leaving account holders trapped. The FDIC communicates that efforts are underway to resolve the situation, with the bank slated to reopen on Monday. Step 5. Over the weekend, the FDIC conducts an assessment of the bank's assets and liabilities. They ascertain that insured deposits total $25 billion, while uninsured deposits amount to $15 billion. The FDIC does not possess $25 billion to reimburse all insured depositors. Furthermore, they are not obligated to cover the $15 billion in uninsured deposits. Consequently, they proceed with a bail-in. Step 6. On Monday morning, the bank reopens. Insured depositors regain access to their funds. Step 7. The bank's stock is now worthless, and the institution remains insolvent. Within weeks, the bank is acquired by an entity such as J.P. Morgan for approximately 20 cents on the dollar. Your stock, which previously represented $250,000 in deposits, is now worth $50,000, resulting in a loss of $200,000. This is the operational sequence, and once initiated, it cannot be halted. By the time news of the bank's troubles surfaces, it is too late. Your funds are already immobilized. Now, consider the catastrophic scenario. What if this event impacts not just one bank, but 20 or even 50 simultaneously? This is the imminent reality projected for 2026 and 2027, when $1.5 trillion in commercial real estate loans are scheduled to mature. These loans were originated in 2019 and 2020, when property values were elevated and interest rates were low. Currently, property values have declined by 40% and interest rates have tripled. Borrowers are unable to refinance, leading to widespread defaults. The banks will experience substantial losses. If 30% of these loans default, that represents $450 billion in losses. If these losses are concentrated among the 186 regional banks heavily exposed to commercial real estate, many of these institutions will fail. Not all 186, but perhaps 40 or 60. The precise number remains uncertain, but a cascade of failures is anticipated. As failures begin to occur, depositors at other banks will experience panic. If you observe on the news that 3 regional banks have failed this week, resulting in depositors losing funds through bail-ins, and you hold funds at a regional bank, what would be your course of action? You would withdraw your money. Everyone would do the same, thus precipitating further bank failures. It is a domino effect. This is the systemic risk that regulators intensely fear, yet they are not sufficiently motivated to address the underlying problem. They are merely hoping it does not materialize, and if it does, they have a contingency plan to utilize your funds to resolve the crisis. Now let me identify who will face ruin and who will manage to escape. Those who will be ruined include small business owners with operational capital deposited in banks. Suppose you have $400,000 in your business checking account to cover payroll and expenses. Your bank fails. $250,000 is insured and will be repaid within 3 weeks. The remaining $150,000 will be converted into stock, which will be worth $30,000 upon the bank's liquidation. Retirees who kept cash in the bank will also suffer. Imagine you are 72 years old, have sold your home, and possess $550,000 in the bank while searching for a retirement condo. Your bank fails. You receive $250,000 of insured funds. The remaining $300,000 becomes stock worth $60,000 after liquidation, resulting in a loss of $240,000. Your retirement is irrevocably compromised. You will be unable to afford the condo and will have to relocate to a more affordable apartment and return to part-time work. Professionals holding trust accounts will also be affected. For example, if you are an attorney holding client funds in a trust account at a regional bank with $800,000 and the bank fails, only $250,000 is insured. The remaining $550,000 is subject to a bail-in and becomes worthless stock. You will owe your clients $800,000, but will only have $250,000 available, making you personally liable for the $550,000 shortfall. This could lead to bankruptcy and the loss of your law license, effectively ending your career. Real estate investors with escrow accounts will also be impacted. Suppose you sold a property for $1.2 million, and the funds are held in an escrow account pending the closing of a new deal. If the bank holding the escrow account fails before closing, the escrow account will be bailed in, resulting in a loss of $950,000 out of the $1.2 million. The buyer will sue you, and you will have no funds to repay them, leading to bankruptcy. These are not hypothetical scenarios. They represent the precise situations that transpired in Cyprus, affecting real individuals, causing tangible losses, and leading to actual bankruptcies. Now, who will manage to escape? The exceedingly affluent individuals are protected because they do not retain liquid assets within traditional banking institutions. If your net worth reaches $50 million, it is highly improbable that such funds are simply resting in a standard deposit account at a prominent financial institution. Instead, these assets are strategically allocated across instruments like treasury bonds, money market funds, investment portfolios held with brokers, international accounts, and various trust structures. This diversification ensures that your capital is safeguarded within arrangements that are impervious to bank bail-in procedures. Consequently, your financial position remains secure. Major corporations are also insulated from such risks because they employ sophisticated cash management systems. These systems are designed to automatically transfer any cash balances exceeding a predetermined limit into insured accounts spread across multiple banks or into short-term government debt instruments. For example, if a company like Apple holds $200 billion in cash, this immense sum is not concentrated in a single banking facility. Rather, it is dispersed across hundreds of distinct arrangements, each affording a high degree of protection. Thus, their financial interests are well defended. Government bodies also benefit from special provisions, as public funds deposited in banks are frequently fully insured, irrespective of the total amount. If a municipality possesses $50 million in tax revenue deposited in a financial institution, and that institution were to collapse, the local government would be fully compensated by the Federal Deposit Insurance Corporation, even though the deposited sum vastly exceeds the standard $250,000 insurance limit. These are specific governmental safeguards. As such, their financial stability is maintained. The individuals who suffer the most are those in the middle stratum of society. These are the people who have diligently worked, diligently saved, successfully established businesses, and placed their faith in the perceived security of the banking system. You are precisely the demographic targeted. You are the ones who will ultimately bear the cost of the financial sector's missteps. So what actions can you take? How can you fortify your financial position? Firstly, ascertain your bank's exposure to the commercial real estate sector. This information is publicly accessible through the bank's quarterly financial filings. Focus on the line item indicating commercial real estate loans as a proportion of total capital. If this percentage surpasses 200%, your chosen bank represents a high-risk proposition. In such a scenario, it is imperative to relocate your funds. Secondly, distribute your deposits across several banking institutions, ensuring that each individual account remains below the $250,000 threshold to qualify for full FDIC insurance coverage. While this approach entails some inconvenience and necessitates managing multiple accounts, it is the sole reliable method to guarantee complete deposit protection. Thirdly, transfer any surplus cash that exceeds your immediate spending needs out of the banking system altogether. If you possess more than $250,000 that is not earmarked for imminent expenditures, refrain from keeping it within a bank. Instead, consider purchasing treasury bills directly through the Treasury Direct platform. Treasury bills are instruments backed by the full faith and credit of the United States government, not by a commercial bank, rendering them immune to bail-ins. Alternatively, invest in a money market fund that exclusively invests in Treasury securities, offering equivalent security. Fourthly, if you are the proprietor of a small enterprise, establish separate business accounts at distinct financial institutions, each maintained below the $250,000 limit. Although this may seem cumbersome, it provides essential financial safeguards. Furthermore, contemplate holding a portion of your operational capital in extremely short-term treasury bills, which can be readily converted to cash when required. Fifthly, should you manage funds held in escrow or trust accounts, ensure that these accounts are structured as pass-through arrangements, whereby FDIC insurance applies to each beneficiary individually, rather than being limited per account. This modification can significantly enhance your overall insurance coverage. It is advisable to consult with a legal professional to ensure the proper structuring of such accounts. And finally, implement these measures without delay. Postponement is not an option. The maturity of commercial real estate loans presents a significant challenge, with a substantial portion scheduled to mature in 2026. We are already in 2026, and defaults are beginning to manifest. Bank failures could potentially commence as early as the second or third quarter of the current year. You may have approximately 6 months, perhaps less. If you delay your actions until you witness the initial bank failures reported in the news, it will be too late. By that juncture, widespread bank runs will have commenced, and you will find it impossible to access your funds. Herein lies the fundamental reality. The framework for bail-ins is already enshrined in law. The FDIC possesses the requisite authority. Banks are excessively leveraged with exposure to commercial real estate. A financial crisis is imminent, and when it erupts, deposits exceeding $250,000 will be converted into equity within failing financial institutions. This scenario has already transpired in Cyprus, and it is legally permissible here, and it is poised to occur. You have been duly cautioned. The critical question is whether you will take proactive steps to protect yourself, or if you will become one of those individuals featured on the news, lamenting the loss of their life savings and expressing shock that no one forewarned them of such a possibility. I have just provided that warning. Now it is time for action. However, there is one additional crucial aspect you must comprehend. The bail-in of bank deposits is not the culmination of the plan. It merely represents the initial phase. Following the seizure of your bank deposits, the next target will be your retirement savings. Your individual retirement accounts, such as your 401k, will also be subject to intervention. Furthermore, a legal framework is already in place to facilitate this action as well. In the subsequent presentation, I will meticulously detail the precise methodology the government intends to employ to expropriate your 401k funds and reallocate them into government bonds, representing a staggering $7.3 trillion in retirement assets. The precedent for such actions has already been established in countries like Argentina and Poland. The identical strategy, leading to the identical outcome. You forfeit everything. Please engage with this content by liking it, subscribing to this channel, and I will present the subsequent details in our next broadcast. Because if you consider the loss of your bank deposits to be detrimental, you are unprepared for the scale of what they have orchestrated for your retirement funds.